From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 25th. Tony Fratto here with Hamilton Place Strategies back on the Macrocast. I'm in New York. Brendan Walsh, John Fagan with Markets Policy Partners and partners on the Macrocast. Guys, it's good to be back together. I had a nice week off last week, I have to say. I didn't pay attention to anything at all. Nothing. I didn't watch the news. I didn't read Twitter.
So free. It was a good week to do it.
I had a very fresh mind. I didn't get angry about anything.
Yeah.
I did break my silence, though, for what was the big news at the end of the week last weekend was the passing of Supreme Court Justice Ruth Bader Ginsburg. Really one of the giants of the court for a few decades now, and a pop icon also, which is like an amazing trick if you can do it. I think she's probably the only Supreme Court justice who can achieve both of those, and in a very serious way. It was very sad to see her passing, and then of course the drama that we're faced with now is some of the ugliest scenes we've had in Washington. Certainly, over my career of working in Washington and paying attention to Washington over the past few decades, the ugliest periods have usually involved Supreme Court battles. And so now we have another Supreme Court battle that we're going to have to deal with in an already volatile and challenging period with a health crisis and a financial crisis, or economic challenges, and an election. The Senate has determined, and the White House have determined, they're going to move a Supreme Court nominee here in these next few weeks before Election Day. I guess we have 5 weeks before Election Day. We're going to try to get it done beforehand. I think we're going to see a nomination. The White House has said by tomorrow, late afternoon, we'll have a nomination, and then we'll be in one of these battles again. And while that's significant in itself, one of the consequences of it for our macro outlook is what this means for the potential for more stimulus. You've had some senators come out and essentially say that this is going to take up all the oxygen in the room. We're not going to have time to do a stimulus. It's been my base case that they are going to get something done, and this does present another challenge. Economic data is telling us we still need it, though, isn't it? I mean, John Brendan. I mean, I saw initial claims yesterday. Again, nearly 900,000 Americans filing for unemployment insurance last week. These numbers are still horrific, aren't they?
Yeah, they're very weak, and especially when you also add on the pandemic unemployment assistance. You're talking over 20 million people that are still receiving benefits, and that's rolling off. But we're also going into the fall, where restaurants are able to survive if you can do outside eating, but it's about to get cold. A lot of New York restaurants have said, we're just going to have to shut down because once it gets cold, people aren't eating inside. So when we look at the real-time data, that has flattened really a month or so ago, and it's actually starting to turn down. So
it seems like people everybody expected the third quarter bounce. The third quarter bounce has come back much stronger than I think anybody.
Yeah, I agree.
I don't know a private sector or official sector forecaster who predicted that payrolls and growth will come back as strong as it has. But that's a different thing from saying that we have come back. I mean, the levels are still well below. We still have a lot of, we have 3.6 million Americans who are still not, they have forbearance on their mortgage, payments. These numbers of, new filers on the horizon, what you just talked about, Brendan, all of these service companies, the goods sector has done amazingly well. That's the thing that was really underappreciated, right? It's like goods are still flying off the shelves. and you can get them delivered and you don't have to touch them.
Yeah, we're just buying them a little differently, but we're still buying the same amount.
Yeah, but anything where you need to be in proximity of other people is still really a really impaired business. And we're still, nothing has changed from what we've said for many, many months, which is the people who poo-poo the need for stimulus keep saying, what we really need is a vaccine. You don't need more stimulus, we need a vaccine. Well, we've always just needed a vaccine, and of course we still need a vaccine, but we've used the analogy of a bridge, or not the analogy, what's it called?
It really is a bridge.
The imagery of a
metaphor.
The metaphor. Thank you. The metaphor of a bridge, and like the bridge still needs to get to the other side, and we're still in that need to get to the other side. So those restaurants that you talked about and all those other service businesses that can only operate at best at 25% capacity, they're not going concerns until we get to that other side to the other bank. And we need to keep building that bridge to the other bank.
Exactly. And so the PPP loans had in it, you couldn't lay people off, but we're basically over that now once we get into October. And those industries that have been heavily affected, like the hotel industry. So their association put out a survey yesterday, and they're expecting monstrous amounts of layoffs in the fall because they just can't survive. So once you're allowed to lay people off in the fourth quarter, you're going to see huge amounts of service sector related layoffs.
And there's rising concern about the second wave. Public health officials had always warned about the seasonal aspects of COVID, similar to flu, and a resurgence in the fall and winter when it is more apt or more transmissible. And we're beginning to see the beginnings of that, particularly in Europe. Europe has ahead of the U.S. Spain is veering toward potentially another major lockdown around Madrid. They haven't pulled the trigger on that, but that seems to be a certainly possibility. We saw earlier this week, Prime Minister Johnson in the UK tightening the restrictions in the UK. Now, those were relatively loose restrictions, and they'd never really gotten all that tight to begin with, but still an admission that something is going in the wrong direction here. We saw Germany's cases. Germany has had a relatively favorable handling and containment of COVID, and their new case loads are up at levels last seen in April. That's, it's based on past experience. Analysts look at that and say, coming soon to a theater near you here in the U.S. And at a time when, as Brendan pointed out, a lot of the sort of outdoor activities, which could kind of cushion some of this, are going to be much difficult to continue, particularly in the colder regions of the United States.
And to your point, Tony, especially about the bounce back. So the second quarter was huge. We knew it was going to be huge, but the bounce back has been much stronger. It's also we report it kind of stupidly. We do the quarter over quarter change, but then we multiply it by 4 to annualize it. So it makes the moves seem bigger than they really are. But there's consensus that, the third quarter, we have tracking on that. That looks like it's doing well. But people are expecting, a 10% kind of growth in the fourth quarter, where the data we're looking at now, it could be negative.
That, is it?
Yeah.
The market's starting to. Well, first of all, are they being alerted? Because we've had a down market, especially this week, and it looks today as I look at. In the market just opening now, and down 130 in the Dow, 7 or 8 on the S&P. So I think this would be the 4th or 5th down day this week, I think.
And with some big moves, we had a couple 2% days.
And we're in a correction, right? Yep. Yeah. So we're in a correction, and our market participants getting this, right? Are they saying, like, look, we're looking at the data and we're seeing it leveling off, and we're seeing, really, a lot of concern about whether there's the political support for additional fiscal measures in Washington right now.
I think the market reaction was heavily driven by the 3 things we just talked about, that The situation in D.C., it doesn't look like we're going to get stimulus. Maybe they're pulling, a rabbit out of a hat here with the House Dems 2.4 trillion proposal, but it's not looking good. Then we've had some weakening data, and the market took bad data as bad because we're not going to get stimulus. And the Fed is pounding the table for stimulus that they're kind of nothing new should be expected from the Fed. And then, like John said, it looks like we're having the beginning of that second wave of COVID, and that's not necessarily good for anybody.
I'm still sticking with my. I am still sticking with my. I've been known to go down with ships, and I'm still sticking with my call that they are going to get something done. And just to put the math on that, so back in, I guess it was May, that Democrats passed a $3.4 trillion plan. And I'm not going to get into the details of it. The $3.4 trillion plan, Republicans in the Senate passed a roughly $1 trillion, $1.2 trillion plan. There's been nothing really done to try to resolve their differences over this period, except I think Mnuchin has had on and off again discussions with Speaker Pelosi. As you mentioned, the Speaker Pelosi and the Democrats are committing to not leave until they pass their new plan, which is roughly $2.4 trillion. They're getting closer to what would be a split the difference. I've always felt that a plan is going to get passed. It's going to begin with the number 1 and not the number 2, but could be in the high one. It could be 1.8, $1.75 trillion and do enough to get them into going into the election and covering this period of continuing to build this this bridge. But I know I am a lonely voice on this, right? I mean,
I agree with you, and for two reasons. One, I just can't imagine a president given the option to give people money a month before an election, not taking it. It doesn't make any sense. And two, the state tax, the state revenue numbers are coming in way better than we imagined. The hole just isn't as big in most states as we have thought, which thus reduces the need for that in the bill, which was a huge sticking point between the Dems and the Republicans. So if you don't need to spend $1 trillion on the states and maybe you fill it with $100 million or $1 billion, that seems like that takes away a lot of the disagreements.
Yeah, and basically this recast bill, which they're going to be coming out with, does have some of the other elements that weren't in the previous version of the House HEROES Act. It has specific support for affected industries like transportation. That's something that Secretary Mnuchin has been very, very pointed about in his remarks this week, the need for specific industry support. And so, he was on CNBC last week saying now is not the time to worry about the deficit. And, it's a little hard to imagine this administration, which hasn't, been fiscal rectitude, hasn't been the hallmark of the Trump administration. And why would they really start now? And I guess the question that I have is, Tony, if Mnuchin and Pelosi come out and say we've agreed on a $1.8 trillion compromise bill, the House is going to pass it. Over to you, Senate Republicans. Do you think the Senate Republicans will actually stand in the way of something like that when they've?
Oh, I don't. I think they will. I think they'll move it. And but look, I think as we look at the likely electoral outcomes here too, I think the numbers are not improving for Republicans right now. They've stayed pretty solid in terms of Biden Trump polling. Biden is holding on to 7-8% nationally. And we could talk about battleground states, and yes, they're tighter, but that's a fairly durable lead that he has had in national polling, and he is leading in those almost all of those battleground states. There is a real risk of Republicans losing the Senate. I mean, Charlie Cook, I saw recently, put it at above 50%.
Yep.
Likelihood of Republicans losing the Senate. So, something to change the dynamic here a little bit.
And that's the most important point that people are kind of missing. It's not just the presidential election.
Right.
There's a lot of senators that are running in real tough races. So why wouldn't they be helped by saving a bunch of restaurants?
If you don't do it for the economic need, look, your point about sales tax receipts is such a great point, right? Like we all assume, me included, me a culprit here, right? That sales tax, you take a huge hit because yes, you get it from goods, but the service sector is a bigger portion of the economy, and that's still impaired. That's basically true, but still, like the sales tax revenues come from selling stuff mostly, and there was still a lot of selling stuff. And in fact, I saw Brian Moynihan on CNBC yesterday, and talking about credit card purchases are up over September 2019. Like who predicted that?
I know. And you look at car sales, even the car companies stopped producing because they figure we're in a pandemic, no one's going to buy cars. And the exact opposite happened because no one wants to take public transportation. So we basically don't have any more used cars because everyone's bought them all.
Exactly. So look, Republicans could say like, look, we saved you, $1.5 trillion that Democrats wanted to give to the states that obviously don't need it because they've got sales taxes, but we are going to target it for education because we know schools have increased costs. So schools are definitely going to get some money, and we're going to do PPP because we have these restaurants and other service businesses that need it. We're going to do that. We're going to continue to do unemployment insurance with some augmentation. And, you wrap that up in a bow and you put $1.5 trillion on it and you move that. Like to me, like that's a no-brainer. We had, we had Mnuchin and Powell on the Hill all week, it seemed like. It's like a running show. I don't know how they keep coming up with questions. They kind of run.
I know, 3 days. I mean, there's only so many things that they do.
We hardly talked about it because there really wasn't news. But I'm going to say, I want to break here and come back. Here's the news. The news had 3 days of Powell and Mnuchin say additional stimulus support is needed. Okay, good. That's the news. We all agree, and we've talked about that in this entire first segment. I'm going to come back in the second segment and talk about the non-news, which was, last month the Fed rolled out its inflation averaging regime, and there was no criticism of Powell and Hill this week for this. So I want to get into that a little bit and talk about how times have changed. So we'll come back in the second segment and get into the Fed and monetary policy a little bit. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, back on the Macrocast. Hey, guys, I remember, I know like 2012, I know it just seems like yesterday. In the slow moving world of, monetary policy, it's kind of like yesterday, these things take years to change, thinking and ideas, but it was like not that long ago that, Rick Perry said that Ben Bernanke should be tried for treason. Because they wanted to defend the 2% inflation.
I think that comes with death. If you get convicted of treason,
right? You die. It's the death penalty for you. For setting the 2% inflation target, wanting to defend it, and he wasn't the only one. There were others out there. Like the Rand Paul and Ron Paul. Pauls with the audit the Fed and Gold and Judy Shelton, the current nominee in limbo for a Fed seat. All of these people just like pillorying the Fed for 2%. And they come up with this new regime, very smart, I think, regime, not without complications. You go up for 3 days of testimony on the Hill, and not a whisper of criticism. For a much more dovish, interest in tolerating inflation for long period of time, really durable periods of time, and telling the market that that's what they're going to do. John, what did you make of that? I mean, was it like, were you surprised as I was that there wasn't even like one, rando who
Yeah, times have changed so much, and the inflation alarmists from the post global financial crisis period, really over the years, they had fewer and fewer legs to stand on, and it was, I think the narrative has really moved on, and we saw, this week the most pointed questions were not about is the Fed doing too much. It was, what's the Fed doing for the little guy? What's the Fed doing for Main Street? What's the Fed doing for, is this the benefit of Fed policy, monetary policy, actually getting some real traction where it's needed most, lower income groups and small businesses and so forth. And that I think is one of the big shifts in the narrative here. It's an attention that the Fed has called upon themselves in their new formulation. When they are targeting full employment, they are specifically now going to be highly attuned to the lower income echelons of the labor market roles. And I think that this is a more productive line of conversation. You don't want to be, you don't want to totally forget about the risks of inflation. There are certainly a lot of analysts who think that the Fed is playing a bit of a dangerous game, goading inflation at a time when some of the fundamental factors and fundamental underpinnings that have kept inflation low over the years may be changing. Globalization is one of those. That has been a very disinflationary dynamic over the last decades. And it's a cursory inspection of headlines these days will tell you that globalization is in a bit of retreat. And so some of these other factors as well may have a inflationary sting in the tail for us down the road. But that's certainly one of the big changes in the narrative. There is a incremental focus to who's really benefiting from Federal Reserve policy here. We'll get a little bit more into that. I think one of the other changes that is even more contemporary is, remember back in the Yellen, as recently as the Yellen Fed, which is even closer in time.
More recent, yeah.
There was among Fed speakers, there was quite a bit of diversity among the committee on easing. There were the hawks, the regional Fed presidents had a little hawkish clique. They weren't necessarily ever going to carry the day, but they had their say. And now there's a lot more. There's a lot more unity of thought. There's very little sort of hawkish rumbling, and what passes as hawkish rumbling is still very, very dovish. And there was a drive, certainly in the Yellen Fed era and in the Bernanke era, to normalize. There, you could tell in the statements of Fed officials there was this yearning to get back to normal rates. What normal really meant was up for debate. But it was, every emergency policy that was put in always had some kind of expiration date on it. It was always, this is just until we don't need it anymore. And then which, the recovery's coming, and then we're going to start normalizing policy. I think that when the Fed executed their swift and perhaps disorderly retreat from the tightening cycle in 2018 and pivoted to easing in early 2019, we just haven't seen anything like the narrative of this return to normal rates.
Yeah.
There's now, I think, an acceptance or at least a consensus that this is normal. And the Fed's policy shift that we saw over the past couple of weeks really cemented that. And when it comes to rate policy, this is now set it and forget it. I mean, they have zero going out.
It seems like we should have pretty boring, FMC meetings for, I don't know, into 2023. What do they have to debate at this point? Balance sheet? I mean, asset purchases?
Well, that's where the line of questioning, one of the lines of questioning veered during and it's something that we've talked about a lot on this show. It's the span of the policies from the Fed. Obviously, interest rates are a very strictly monetary kind of policy. But we've seen the mission creep of the Fed, so to speak, or the expanded mandate of the Fed to go into these quasi-fiscal programs that were funded by the CARES Act, specifically the Main Street lending program and the municipal liquidity facility. These are monstrous programs that have a distinctly fiscal kind of flavor.
Potentially monstrous programs.
Yeah.
I mean, municipal facility is not fine, but like just it's more like a mouse than a monster on the Main Street lending program. Would you say?
Well, I think that's giving I think that's an unkind characterization of the size of a mouse. I mean, this is more like a
the mouse could be huge, but it hasn't been.
I mean, the vanishingly small sliver of capital that has been deployed from the Main Street lending program. What is it? 1.5 billion, Brendan?
Yeah, and by his own admission during this, he thought maybe you could get up to 30 billion by the end of the year.
He's dreaming.
So you're talking about $500 billion just sitting doing nothing.
Yeah, this is a program with $600 billion in firepower. And the municipal liquidity facility has $500 billion, and
so $1 trillion sitting doing nothing.
Right, and that's seeded by over $100 billion in real fiscal money.
Yep.
That is backing those programs, and that's real capital that could make a real difference, but it's sitting inert. And the Fed was, I think justifiably getting some. Chair Powell was getting some really challenging questions on this. The premise that. Yeah, Main Street's hurting, and you have a facility called the Main Street Lending Program. Then, that isn't doing anything. What's the problem?
I agree. We've expressed ourselves on this now for a while now, and it's true.
Right.
I have some. Look, I think Fed did a really marvelous job of communicating and rolling out the new inflation averaging framework. I think their communication up to it and after it, and moving the tools, forward into the September meeting, were all really just handled brilliantly. It really was. The communication around Main Street Lending Program has been terrible, and I do have empathy with his point, which is the Fed can do lending, and the Fed is not permitted to do lending into in ways that can lose money and can be anticipated to lose money. So I get his point. We can't do more than demand of what is the demand for good credit, and so that's all we can do. Okay, fine, I get that. Put the money back over to the guys who can give the money away. That's all I'm saying.
Yeah,
if the envelope for this should only be $50 billion, that's fine. Put $5 billion over at the Fed, take the other $95 billion and give it back to Treasury.
And I think Chair Powell, he sort of did himself a little bit of a disservice by characterizing it as unfixable, basically. He said, at one point, we've done basically all we can think of, and nothing works. And, intimated that they may do a little bit of tweaking, but it really wouldn't have a great effect. That quote was, of course, taken out of context repeatedly by market commentators as a broad expression of Fed helplessness. Yeah. And that's bad. That's.
I watched him say that live, and I watched it, and the image that popped into my mind was the emoji shrug. It was like shrug. I get what you're saying. He was specifically talking about what they can do with the Main Street Lending Program, not about
it's irresponsible to say that Fed Chair Powell was characterizing monetary policy as, out of ammunition. We've done all we can think of. He was talking about the Main Street Lending Program very specifically. But the fact that this caught the headlines and caught people's notice and was taken out of context, and some analysts ran with it, really does speak to the larger point, which is it wasn't just Fed Chair Powell's testimony this week. We had a gauntlet of Fed speakers, a massive barrage of Fed communications, and they were almost entirely unanimous, except for noted gadfly St. Louis Fed President Bullard. They were almost totally unanimous in hammering home the absolute desperate need for more fiscal support and the dire prognostications for the economy if that fiscal support isn't forthcoming. And that was during a time when everybody's expectation of the odds of that fiscal support coming through going way down. Yeah. And so that was bad for sentiment. And the implication on the flip side of it was, with all these Fed speakers just constantly saying how important fiscal policy is here, it sort of diminished the belief that markets have that monetary policy can really make a difference. And it sort of gave not great for sort of Fed credibility and the belief in the effectiveness of their policy.
And that's really the challenge for them going forward, isn't it? I mean, all we're talking about is their credibility to, not just to achieve, I said before, like to dunk. Can they dunk? We're gonna find out Powell can dunk. Can he dunk? And they can keep dunking from now until 2023. We need to show the credibility that you can actually achieve the target, that you are committed to it, and you are in fact doing everything you can do. So any signaling that we've kind of run out of stuff to do is not going to be received well by the market.
Well, that's where the market participants are like, hey guys, aren't you forgetting something? It's called QE, right?
Right.
Right. That's the sort of unspoken thing. Now, markets are, as we've discussed amongst ourselves, markets have a posture toward the Fed of like a spoiled child at this point, which is like if the Fed gives them everything they want and then they decide they want more, it's like the kid that gets an Audi for his birthday and says, I wanted a Porsche, Dad. It's like that ingrate kind of attitude. And now the markets are thinking, well, what about QE?
So the market is basically
left.
Yeah, the market is basically Veruca Salt, But I want an Oompa Loompa now, Daddy.
But the
Oompa Loompas.
And it didn't go unnoticed that Treasury Secretary Mnuchin, in his comments on CNBC, when he said now's not the time to worry about the deficit, he also said now's not the time to worry about the size of the Fed balance sheet. Back in the old days before 2016, that would have been seen as a very serious breach of etiquette for the Treasury Secretary to go talking out of school about the Fed's balance sheet. That's not, and not to worry about it. That would have drawn a nasty gram from the Fed board and probably the New York Fed as well to the Treasury Department. But this is there's a clear indication here that the policymaking, a lot of sectors of the policymaking community have absorbed this understanding of quantitative easing, which is Fed asset purchases, that has existed on Wall Street for the past decade, which is QE is magic fairy dust that when liberally applied can instantaneously and costlessly levitate asset prices at the whim of the FOMC. And so the degree to which markets are keyed off of and sort of hooked on QE is a very it's a very interesting dynamic.
Yeah. And it's one of the things that annoys me that people compare Fed policy to a gun and that the Fed is out of bullets. No. They don't have to do something new. They can always just buy more stuff. Whether you think it's a good idea or not, they're not out of bullets.
They'll never be out of bullets. They will never be out of bullets because they have unlimited capacity to buy bullets.
Exactly. Yeah.
In fact, they conjure up bullets. So yeah, I don't like gun analogies, but I think you're right. Well, look, I do want to get back. I want to come back in a future Macrocast and talk about, how I think the Fed policy is terrific. I think it's the right way to go. I think it's unusual that it's actually, coming in. When they first started talking about inflation averaging, we weren't in this COVID economic strain period. We were at full employment, and it was a very different period when they first started to study it. Well, they've been studying it forever, but when they did this most recent effort. But there are potentials for creating financial stress in the future. Depending on how they go ahead and execute their commitment to it. So I want to come back in a future Macrocast and just talk about that. What are distortions that could be caused by them, trying to execute this policy in the future? And we've got a long time to get into that, but I think we should get into.
Oh, that's a great idea.
Yeah. I want to we'll take our last break now and just come back and look ahead to next week. But I definitely want to find time for that very, very focused Fed discussion on how they're going to execute this policy and what the consequences could be. You're listening to the HPS Macrocast.
On the first Friday of every month, HBS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, back on the Macrocast. Brendan, what are we looking at next week?
Well, we have a lot of the PMIs, the global PMI data for September, but the reality is none of that matters because it's Jobs Friday. That's what the market will be keyed in on, and that's what we will be paying attention to.
We need one of those sound effect things for
dun, dun, dun.
Today. Some kind of, we need a sound effect.
Yeah.
We need to get on.
We need the Macrocast theme song, too.
That's true, we do.
HPS has a lot of talented associates. I think we can come up with something.
We definitely need a theme song. That's cool. Well, with Jobs Day will be fun. We'll have the great Matt McDonald back with us to go through the numbers.
It'll be interesting. The dollar's gotten a little bit of a bounce here despite some pretty muddy U.S. data. And that's down largely to risk aversion, safe haven demand, and that sort of thing. But we've seen non-farm payrolls in the past surprise to the upside. Treasury markets kind of shrug, equity markets kind of shrug, but it has moved the dollar. So that's fun to watch.
All right, guys. Good show.
Have a good weekend.
Yeah. Enjoy the cooler weather.
Will do.
Windows are open.
Get out and get up to some of these outdoor restaurants while you can.
Yes, exactly.
Right.
All right. We'll catch you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.